MK Surana, former CMD of HPCL, is now joining us to talk more about the OMC space, which he understands like the back of his hand. Mr. Surana, good morning. Thank you so much for your time. How do you see the outlook for oil marketing companies in this light, Mr. Surana? That on the one hand, Brent is continuously under check, under 80 now, and plus these OMCs are actually transforming beyond just being distributor of traditional fuel as well.
Good morning, and thanks for having me on your show. So the stage looks good as of today because the crude is below the psychological mark of $80. The demand weakness, the global demand weakness, as per the many of the agencies who forecast that, is getting moderated from all the three agencies who have been doing IEA, EIA, or OPEC. The Indian demand is good on the overall, while the global demand is lower. And the people have started recognizing the weaknesses in the China's demand growing in the current phase. On the other hand, there is a uptick on the GRMs, like the GRM, Singapore GRM is around $5 now in the August, this 20-25 days, what we see, compared to what it was $4.6 in Q2 or $3.5 in Q1. The diesel and petrol cracks are reasonably okay, $13 on HSD and around $11 on MS. So all these things put together makes a good setting for the oil marketing companies if the crude remains below 80 and the cracks remains in $13 and $11 for HSD and MS. Then I think the OMCs are well placed on an overall setup. In addition to that, many of these OMCs on the new path which they are going, there is a growth potential in that. And so we can say that OMCs are in a stage where there is a growth potential with the surety of the existing cash flows. Of course, the overhangs on the pricing part continues to be there, the possibility or not possibility of some interventions. But over last 3 years, I think the market has seen the robustness and the resilience of these companies to navigate through various challenges which comes, whether it was COVID, whether at the high and low crude prices, whether very high cracks and very low cracks also. So I think that overall the setup is good, and the possibilities of the rate cuts and the good monsoon and the festive season coming in. The demand growth also should be good, at least in the Indian market. I think the July growth was almost more than 7% with MS and HSD. MS was almost 10%. LPG was also 10%. So overall, it looks good.
And, just in continuation to that point, Mr. Surana, how much would have marketing margins increased for some of these companies? And would higher marketing margin make up then for the under recovery in LPG?
So we need to see on an integrated margins, because over a period we have seen that the prices had been kept constant, and there are reasons for why it should be. We can always debate on whether it should be or it should not be, whether it should be completely free, whether it should not be. But I think on the integrated basis, it looks reasonable right now. There will be under recovery in some products. There may be slightly over recovery in some products. But I think if you put together the integrated margin of refinery and marketing put together, it is reasonable.
So, Anna, on a broader scale, next 3 to 5 years, how do you see the the profitability? Annual profit, 18-20,000 crore kind of annual profit. In some cases, OMCs are 30,000 crore in case of BPC or thereabout. How many levers do OMCs have now? The way they are doing tie-ups with electric vehicle companies or OEMs for charging infrastructure at the same place. There are petrochemical forays happening. Lubricants is one business. Can the numbers of oil marketing companies improve meaningfully in a 5-year period from here?
So we need to see the capex cycle of the companies, and they are different for all the three OMCs as of today. In some cases, the projects are about to be commissioned or just commissioned. In some cases, the products are being launched now. And considering the time period which it needs to fructify these projects, the different companies will have different trajectory for incremental profitability growth in the time to come. while a lower crude price, which appears that in the near term, the crude prices are likely to be benign. And if that being so, the marketing margins should be reasonable, and which will help these companies to take up the projects and fructify the projects which are already taken up on the traditional business lines which we had, like refinery or pipelines or marketing setup. The new growth engines which are coming, especially in the renewables, greens, and I will say the middle level, the petchem, which is not absolutely new, but all the companies had been integrating the petrochemicals with the refineries. And while the petchem margins currently are low, but I think they should improve as the demand picks up. And in that case, the existing growth engines, existing money spinners should make money, and that should also help in funding the new capex cycle for the greener, etc. And by that time, it may mature, let's say in 3 to 5 years' time, the new business lines like green and alternative energy and renewables, etc. On the EV front, there's always a narration whether hybrid is better or the pure EV cycle is better. But the OMCs are better placed to play both the things, whether it is hybrid thing where it is just a combination of their existing business plus the EV charging setup which they are putting anywhere. And if it is pure out and out EV, also it can be put. But my personal thinking is probably the pure EV play may take some more time, and the hybrid may be more common in the near future to come. And that augurs well for the OMCs.
Mr. Surana, such a pleasure having you on the show today and give us all that perspective on what really crude price movement means for both LPG as well as the OMC players. Good to speak with you today.
Thank you. Thank you very much.
If you like this video, then like, share and subscribe to ET Now.